Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I'm a valuation expert in St. Louis, Missouri. I have the pleasure of discussing the impact of COVID-19 on business valuations and this concept called EBITDAC, so EBITDA with a C, with Achille Ekeu, a business valuation expert in Washington, D.C. Welcome, Achille. How are you?
I'm doing very well, Melissa. Thank you so much for the invitation. It's a pleasure. It's an honor to be part of your guest. This is a very sought-after show, and I think the opportunity to be able to share my thought with the public, with your public, is it's an honor for me. Thank you so much.
Oh, well, thank you. Well, the reason why we kind of wanted to get you on the podcast is because you're writing a lot of information about COVID-19 and the pandemic and its effect on business valuations. And I think any business that is currently going through a valuation or considering a valuation really has no idea how this impacts it. So I think a simple place that we can start is, how is the pandemic really impacting small business valuations? Can you kind of walk us through some of the things that people are seeing?
Right. So this is a new normal. It's becoming a new normal nowadays. When this pandemic hit us back in February, we remember the stock market went down. Everything went upside down. People were really surprised by the impact of that virus on our society, and it really has not changed till today. We're hoping that it was going to be gone by this time, but it's still lingering. It's still around. There's even a second wave that is still wreaking havoc in our communities, and so it's the impact on small business is absolutely devastating. It's amazing how, despite all the efforts of different states and the federal government and business owners, investors, we're still feeling the pain of that virus. And the impact of that virus on business valuation is even more devastating, because people are losing the wealth that they built over time in their businesses. So the way to really analyze the impact of this coronavirus on business valuation is through three metrics, or three drivers that are drivers of value. That would be cash flow, that would be growth, and that would be risk. So we're going to talk about those three different aspects of the impact of coronavirus.
Well, and I think that part of the issue with small businesses, just like you identified, is we all thought this would be over. And so now we have a longer time frame with which to deal with it. But in general, though, in the business valuation community, we've all agreed that business valuations after December 31st, 2019, that was the last date that we could possibly have not known about the pandemic, right? So and this date becomes important because anything after kind of January 1st, 2020 and on, we have to take into account the effects of the pandemic and COVID-19 on current cash flows and on future cash flows. So, I mean, that becomes important in the valuation community, and that's why everybody's talking about this. But you break it down even further. And so let's start with, what is the impact of the pandemic on cash flow? Because that's where a lot of people are concerned right now. Where am I going to get the money? And can I get funding, or, however I get debt and things like that? So tell us about cash flow.
Right. So we all know that cash flow comes from your earnings, and your earnings derives from your revenues, right? So it's the impact of the COVID on revenues is absolutely directly impacting your cash flow, right? So because people can't go out and shop and do what they normally do, and spend the money and do whatever they always do, because they're locked in their homes, or they can't, for whatever reasons. So that has a direct impact on small business owners. It has an impact directly on their revenues, and the revenues, you know, are where businesses measure how they grow. What the profitability comes from that revenue. So the expenses usually are about fixed. They're fixed. You have usually fixed expenses, some variable expenses, but most of the time they're fixed. And so so when you deduct that, you get your profit, right? Cash flow cash flow comes from profit. Once your profit go down, your cash flow goes down. Therefore, the impact of your valuation is felt right there. Absolutely.
Well, and I think that even in this pandemic, I mean, we've also seen some companies that exponentially are more profitable in the pandemic that were not profitable before. And I think that it's trying to get a handle on, you know, what is the impact. But we also have to, so first we have to understand cash flow, right? And then we have to understand what is the impact of the pandemic on growth, and what do we even mean by growth?
Right, growth is about when a company is slated to grow, for example, at 2% or 3%, you know, year to year, right? So it depends. It's a projection that companies do for themselves. You know, they project that they're going to be growing 2% or 3%, you know, this year or the following year. So when that projections, it's put into question because the fact that we're not sure about what's going to happen in the economy. We don't fully grasp what's going to happen in our surroundings, you know. So we kind of feel like, well, this growth may not be realized. And so because those growth projections are not, we can't rely on those growth projections anymore, it has an impact on our revenue and therefore our valuation. So the growth potential of a company is what small investors or big investors look for. They come to your business, they want to look for the growth potential of your company. And when they find out that, wait a minute, those growth potential are not there anymore, they're not reliable. So they start feeling that, there is a risk, you know, for me here to go into this business. So they're reluctant to invest. And because of that, it impacts directly your cash flow, which again impacts the valuation of the company. So that's the impact of growth here.
Because a lot of times we're looking at growth from revenue growth, from expense growth, even a long-term growth rate, which in the past, you know, we would look to various industry resources and sources of historically what's the growth been in this industry.
Yeah, exactly.
And now we have the pandemic, and it's like, wait a second, how are we supposed to predict the future when there's so much uncertainty, right?
Absolutely.
And we can't even rely upon the historical growth in the actual company, which is also difficult, right?
Absolutely.
And then we have the impact of the pandemic on risk, or the discount rate, or a capitalization rate. A lot of people know it by different terms.
Right.
But talk about how it's affecting the risk.
Right. So the risk of an organization include external risk and internal risk. So external risk are risk to the industry that the company is involved in, risk to the economy, in the economy, you know, nationwide, the economy of your state or your region. So those risks, those external risks, are risks that you cannot control. A business owner cannot control those risks, but the business owner has to try to use that and try to find ways to mitigate those risks in his company. But there are also internal risks. So internal risk are risks that are related to, you know, the internal operations of the business, including, for example, you know, customer diversification. If you don't have enough customer diversification, that could be an internal risk. If you also have, let's say, one key person that is working for your business, that if that person is sick, then you can't run your business anymore. That is a high risk as well. So those are type of internal risk. So when those two are combined and then added to the impact of COVID, which creates even more uncertainties and more risk, then the impact on valuation is really, very hard. So, so the higher the risk, the less the value for a company. So if your company is very risky, the value of the company is going to go down. This is why it's important to really have a good understanding of those risks and try to find ways to handle them in a way that will save your company's value.
Yeah, and I think that people don't always understand how we look at risk. And if we look at a discount rate or a cap rate, we're going to build it up, right? And we're going to build it up with a risk-free rate, which is lower now. We're going to build it up with an equity rate or an equity risk premium, which is lower now. So in theory, there's less risk, right? Because interest rates are lower, but the company-specific risk or the risk having to do with that particular company is higher. So it's sort of like you would think that the risk would go down, but that doesn't make logical sense because we're in the middle of a pandemic.
That's right.
And so the reality is it's really risk related to that specific company that is exponentially going up, even when the other rates are going down, which it's all also, you know, it just makes our job a little bit more interesting and difficult, right?
Absolutely, very challenging. So that's why we have to take into account. And you mentioned earlier that since the COVID prior December 31st, 2019, COVID was not in existence. So we cannot really count that as part of our valuation, as part of something that we can foresee, that was foreseeable or known or knowable at the time of the valuation. So that's why when an expert does a valuation, he has to pay attention to the date of the valuation. He has to make sure he has a conversation with a business owner to find out what is exactly the date of the valuation. If it's, prior COVID, it's going to be different than, pre-COVID. So, then after COVID. So it's going to be something that they would have to figure out first. And then based on the answer of the owner, then they will decide what is it that they need to do. But that is the first thing they need to do, find out of the date of the valuation.
Well, and I think the concept of known and knowable is an important one. And so the only analogy that I can give is if on January 2nd of 2020, your business, building, everything burnt to the ground. On December 31st, you didn't know that it was going to burn to the ground. And if our valuation is as of December 31st, even if we're valuing it in March, right? So we know the building burnt to the ground. Right. What was known or knowable as of that December 31st was that this business would just continue. We didn't know it was going to burn to the ground. And so we can't incorporate that information. And I think that that's a difficult concept to understand because even what we knew in March about the pandemic was completely different than what we know now, right? And it's probably going to be different than what we know in 6 more months.
Yeah.
But it comes to a very interesting term. So everybody knows what EBITDA is or EBITDA. People say it all different. But what is EBITDA with that C at the end or EBITDAC or I don't know what we can call it. But so what does that mean?
Right. EBITDA is earnings before interest, taxes, depreciation, and amortization. Now, the C that is new today is coronavirus. So what is it? It's a new metric. It's called a non-GAAP metric that some companies are using to add back some of the losses that they have incurred because of the COVID. And they're adding that back on their income statement or and the balance sheet and things like that. And so it is skewing the numbers and allowing them to be able to get more loans from lending institutions because they what happens is that the leverage ratio of the company is not the correct one. It's affected by that add back, which makes things look good when they are not that good, in fact. So when those numbers are tweaked like that, they can allow a company to get a loan from a bank because the bank is going to read some numbers that are wrong, but we not know they're wrong, and give that client a loan, which that client may not be able to repay later and then therefore maybe go to bankruptcies and kind of issues can arise. So for that reason, many organizations are against using that metric. Most of these organizations are organizations that protect investors. The SEC, for example, is one of the main organizations in the United States that prohibit the use of that metric. But we still see that around, and so it's something of a concern at this point.
Well, and I think that in general, people are kind of trying to get to EBITDA to see what the cash flows of a business. So if you're adding back, basically, okay, it cost me 200 grand to, clean everything and get the proper equipment and all of this stuff, right? You're just saying, well, let's just remove that $200,000 of expenses because it's going to end, right? Because we all thought this would be over by now.
Yeah.
And it's artificially increasing cash flow, which makes the business still seem profitable, but we're ignoring the fact that what if these expenses continue, right?
Correct. That's right.
Or you have other expenses that continue. Now, in the same breath, though, I think that you could look at a company. What if they're wildly successful during the pandemic? Do we think that that's going to continue?
Well, we don't know. So the pandemic is taking through different rides, and some people are making more money than they usually do, and some are, but we know the vast majority are losing business. They're losing money. So there are few companies, few industries that are making money. That is a fact. If it's those industries that make I don't know,
masks,
all these products that are coronavirus related. Yeah, definitely they will thrive. But for the most retail stores, restaurants, hotels, transportation companies out there, they are really, really feeling the pain very, very badly. So it's something that we need to figure out how to deal with, but we cannot, for the sake of trying to maintain your business, start reporting wrong numbers to the SEC, feeling, because, you have an excuse, or well, because of the corona, I should have made $200,000 more in terms of revenue, but because of that, I can't make that more, that extra income, and therefore I'm going to add that back as part of the coronavirus new metric. So no, it's a no.
Yeah. Well, but I think that you bring up a good point, because the SEC isn't really somebody to mess with. And so why are some companies still using this non-GAAP metric? And, should they reconsider?
Yeah, I think definitely, especially publicly traded companies who publish their statement to the SEC every quarter or every year. Yeah, so they have to be very careful about using those type of metrics, because that could come back and hurt them very, very, very badly. So absolutely. So they should stray away from that. And many organizations, like I said, are prohibiting the use of that metric. It's a non-GAAP metric. It's not something that makes sense. Just because of a situation you lost money, you don't get that. You don't get to discount that loss because you feel, because of what you feel. No, it's a reality you have to deal with, and so it's important to keep things real.
But what if I'm a non-public company? Like, what if I'm just a privately held, smaller business, and, why should I get dinged for all of this extra expenses? And do I care what the SEC says? Because I'm just trying to get more investors. So I'm just showing this metric. Do you think it's maybe reasonable to use it at that point?
From the business valuation expert standpoint, it's very dangerous if they venture in that area. Remember, valuation, if you do valuation, people use the valuation report for a variety of purposes. For example, for tax purpose, it goes to the IRS, and the IRS has to use that report to be able to issue a tax bill. For example, in the case of a gift tax or an estate tax, It's case of an estate tax, for example. And then the valuation reports is also used by lending institutions, by investors, and things like that. So if you submit a wrong report based on wrong data, that is going to give a false impression to those people who are using that report, and that could come back. As we know, business valuation experts are also vulnerable in that area. They could be fined, or they could be, there are all kind of sanctions that we could be going through, even litigation in some cases if it's really egregious. So people have to be very careful. Just because it's a private institution doesn't give you the right to be able to issue reports that are based on false information. Yeah.
So, which is where we kind of come in and use professional judgment.
Absolutely.
We're trying to say, okay, I understand that maybe these expenses are not going forward, but, we still are showing a loss, or there's still actual happen. And I know we talked about the SEC, but are regulators really for or against this metric? And do they have clear positions, or are they just now starting to take positions on this metric?
I think from the beginning, and I think the SEC also issued some rulings on that a few months ago, around June, warning people who are trying to use that metric not to do so. So they are overwhelmingly against the use of that metric, overwhelmingly. So it would be wise for people to stay away from that.
And so to that end, what would be the consequences if we use the metric as a public company, as a private company? You've talked a little bit about how if you're going to send it to the IRS, that's going to be an issue. Yes. But are there any other consequences? Are there consequences for valuation people that maybe use this metric?
Yeah. So yes, just what I said earlier, valuation people may have consequences because they may get fined, or the IRS could sanction them in different ways. Valuation experts know that they have to be very careful in using professional judgment, because they could face some consequences, and they don't know the extent of the consequences at that point. But it's important to be careful when you analyze a business. Understand, especially if the valuation date is as of these times, when the COVID is already hitting, you have to be very careful in doing the analysis properly and making sure that there is no overstatement or understatement of some of the numbers that people are bringing to you. So you have to be very rigorous in that regard, and based on that, so that you can have a good valuation report that you can defend if anything comes back against you. Could we never know? We know, but litigation always happen. We are also vulnerable to litigation, so things can happen, and you don't want to put yourself at risk. And for small business owners, it's very important for them to report their numbers accurately, regardless of the fact that they don't like it. They don't like it, that's fine, but you have to report the numbers appropriately, so that we can analyze the businesses as they are as of the date of valuation, not a fictional number because of what they feel the number should be.
Yeah, totally understand. Yeah. Well, and I think that one question that kind of comes from this is how should we deal with COVID-19 in a business valuation? Either maybe we need to go through it from a cash flow standpoint, a growth standpoint, and a risk standpoint. But in general, what are some of the things that you're seeing, and how are you dealing with it in a business valuation? Because in some respect, I think from my perspective is that we are having to go much deeper and in the analysis part of the history, but also much deeper in projecting what the future looks like, and understanding the expenses going forward. But what are you seeing as ways that we can deal with this in a business valuation?
Well, there are different people that are dealing differently with this issue. I've spoken to some business valuation experts who are saying if the valuation date is after the COVID, they will not take the valuation.
Oh,
I've seen some people say it. I've heard some people say that. Yeah, some people email me and talk to me about that in some conversations. But some people are unsettled. They're not really sure how to deal with this. But it's our job as business valuation expert to learn to incorporate economic situations into our work, and so do it the professional way without trying to make some outrageous judgments and things like that. So we look at the numbers as they are, and we analyze the business as we always do, and then determine the value based on what we know. So that's the standard, and we have to keep staying in on that standards regardless of whether COVID is here or not. So if someone doesn't feel comfortable doing evaluation during this COVID time, I think it's best to take some time and really understand the company, understand the business, do a good analysis, and they will feel comfortable. Because nothing has changed in terms of the way we do our job, the way we value companies. It's just that there is an element that comes in and that really affects profitability for companies. And if it affects the profitability, it should not affect the way we do our job.
yeah, absolutely. And I think the reality is the businesses that have been consistent, insurance companies, some accounting firms, there's certain lines of work that people are going to need that work regardless of what's happened in the pandemic. And so you kind of have a consistent pre-COVID, post-COVID results. Well, those are the easy ones, right? Like we're just kind of coming in and doing what our normal job. It's the other ones that we start to see that either have a dip or an increase. And the hard part is we don't know if you could just eliminate that,
Right.
So the EBITDAC, whatever we want to call it, is basically just saying, you know what, we're just going to get rid of that. We're just going to act like it doesn't exist. And you're as profitable as you have been in the past. But that may not mirror the economic reality, which is this has significantly changed. Everybody talks about a new normal from like as a human, right?
Mm-hmm.
But we're dealing with the new normal of the business.
That's right.
And okay, so now how do we predict the future, or can we use the past? And there isn't, the unfortunate part is you and I could sit here for the next 24 hours discussing it, right?
Right.
But there is no answer. And so you have to use your professional judgment, and you have to use, go deeper in the industry, go deeper in the effects of this business, and have more discussions even with the business owner of where they anticipate going. I've seen some companies that have really, I don't necessarily like the word, but they've pivoted and they've done it well. And they may no longer go back to that old type of business.
That's right.
So we can't really value it, or can we value it based on the historical operations?
Absolutely. There are a lot of changes, a lot of structural changes that many companies will have to do if they want to survive. And so we as experts have to take that into account. And so it's again, like just like you said, we have to talk more, we have to discuss more. Projections are one of the key method that people use to value companies with this COVID-19 now, because everything, we can't rely on historicals anymore because of the fact that we don't know what the horizon is going to be, and those numbers that we had in the past, they don't apply today. So we have to probably go back. We have to probably use projections, and then based on data that we have today. It's been around, COVID's been around now since what, 5 months, 6 months now. So we have some data that we've already gathered from the company, and then so we can use that and extrapolate. But what we know for a fact that companies are only going to go, are only going to do better from this point on. but we don't know how long this point is going to last. And that's where our professional judgment is going to come to matter here in terms of how we're going to project, those revenues and then try to value the company based on those projections.
Yeah. And I think let's just talk a little bit about projections and company forecasts.
Right.
And, a lot of small businesses don't necessarily create a forward-looking projection, forecast, whatever you want to call it. And I know everybody has nuances about which one's which, right? But in general, smaller businesses, maybe under 10 million in revenue, under 50 million in revenue, who knows? They may not have a practice to come up with that. Do you work with the business owners if they're coming in for evaluation? Do you work with them to kind of cultivate some of that? Or are you, because there's a lot of people in the industry that have different opinions,
Right.
or are you sort of hands off? They need to come up with something and then I'll rely on it.
Right. So that is a conversation I had with my team here in Maryland in DC, when we had the COVID-19 event back in May. So yeah, that's essentially a business expert should only you can work with the business owners to create projections, but those projections have to be owned by the owner. Okay, you cannot be doing projections and doing the valuation, at the same time directly. So you can guide business owners to do their projections, and then based on their projection, you can use that now as an independent expert and do your valuation. So that's been the standard for projections. So that would be normally two separate engagements. Some people do two separate engagements, one engagement to help the owner put together some projections. Because what happens is, even when they give us those projections, we still have to analyze them and see how realistic they are, and maybe, have our input, maybe accept them or reject them. So we can guide them to do that, but those projections are coming from management. It's not our own. The management owns it, and then we can therefore use that at that point to determine the value of the company.
Yeah, most of the time we're kind of trying to pressure test it, right? We're trying to say, that doesn't quite make sense. Or, a lot of times we can pull industry data. Valuation people have a lot of access to industry reports that other people don't have access to. And we can look at, well, your gross profit should be around here, or your net income should be around here. Why do you think you're exponentially more profitable than everybody else in the industry? And then they have to kind of defend that, I think, in some capacity. But I definitely agree. Management has to buy into the projections and be an integral part of it. Because I don't know how much are you going to sell next year? That's, or I've seen business owners also get like their main salespeople involved with some of it. But either way, we still come in and try to take a devil's advocate look at it and say, is that really what's going to happen? Or is that pie in the sky?
Exactly. You have to question the assumptions, you have to question, a lot of things. And then once we're satisfied, then we can say, okay. Otherwise, they have to be reviewed because it doesn't really do a business owner any good to have a valuation that is overstated. It's not in their interest. So they have to understand that it's for their interest, for their best interest, that valuations, the value of the company has to really reflect what's really worth, what the company is really worth, and not some fictitious numbers to please them. No, that's not what we do. So the data that they give us, they really have to be rooted in some really strong, some strong data, or market analysis from market analysis companies and things like that. Or the projections have to really be realistic, very realistic. Otherwise, it's just valuation for valuation, which is not in the interest of the of business owners or the valuation expert, for that matter.
Yeah, and I mean, realistically, an income approach is a product of cash flow and risk that the cash flow will continue.
Mhm.
And so what we're seeing is that we have to spend way more time understanding the cash flow going forward and the risk going forward. Whereas in the past, we could rely upon the historical operations. And so if you have no reference point from history, right? And that's not every company. We understand that. But for some of the companies directly negatively impacted by COVID, we can no longer rely on the past. And then we have to look towards the future. And that's also a highly unknown. And so some people are kind of saying, okay, well, maybe do the cash flow of best case and worst case and like probability based, which also comes to be more subjective as well. So, you know, the reality is there's not a lot of right answers to the question of what do we do now, but there are a lot more questions of, you know, does this really reflect the economic reality of the company?
That's right.
And sometimes we don't know. I mean, a lot of people are predicting maybe we'll come out of this at the end of 2021.
Yeah.
You know, so we'll just sit back and relax and hope till then. Now, in the same breath, I don't know if you get involved in any mergers and acquisitions, but this really, you know, companies are still buying and selling right now, and there's still profitable companies out there. So just assuming that we don't know what's going to happen doesn't mean that these activities aren't continuing to go on. People are still really needing the services. I think they just have to understand that there's more involved than what used to happen in the past.
Exactly. Absolutely.
So we've talked about a lot about COVID and pandemic, but one thing we haven't talked about is your company, your background, and we talked about at the beginning, you write a lot, but you've written about this concept. But tell us more about you and your background.
Well, my name is Achille Ekeu. I am a business valuation expert coming from the banking industry, where I worked for around 20 years at different positions. The last one was I was a regional manager, vice president for a big organization that I'm not going to name here. But I've been in banking for a while, and the reason I left the bank was because I felt that there were no more challenges for me. I wanted to go into an area where I would challenge myself even more. And I happened to have an MBA, and I was doing my doctorate degree at the time, and so I felt that it was good for me to move into something different. So business valuation came along. I discovered business valuation just by accident, but I was thinking about doing it already because I noticed that many of my clients, especially business clients, they were getting loans, their loan applications decline a lot. And so that really made me think, wait a minute, why are they declining those loans so much? And so the bank metrics for loans is debt income ratio and things like that. So I discovered that, wait a minute, if they could submit a business valuation report with the loan application, even though the ratio may not be what the bank is looking for, that could also have a big weight on underwriters' decisions. And so I started, advising people to get a business valuation and put in the reports. And lo and behold, people start getting more loans approved. So that made me think, wow, so I need to get into this niche. And how do I get into this niche? A simple Google took me to NACVA, which I discovered, and I submitted my application. I did my certification. I passed my test the first time. And so I got my CVA since 2012. So that's what I do. I'm the president and CEO of the Washington Valuation Group. I'm also the state chapter president for NACVA in Maryland and DC. And I also published a book recently, 30 Frequently Asked Questions in Business Valuation. We had a lot of success with that book. NACVA even purchased a lot of copies and sold them very fast, so they want more copies. So we see. So I have other books that I'm writing, but in addition, I also publish in the NACVA's journals, Quick Read, and other journals. And so so this topic is very near and dear to me because I see a lot of business owners going through difficult times with this COVID. So I thought, they needed some advice from experts like us. And when I looked around, I didn't see, pretty much anything out there. So I thought that I could contribute to that. And so that's why I publish a lot on this area. So
well, and I think that it's important to help business owners understand what's entailed in this process,
absolutely.
Or if they're bankable, sometimes we do valuations, but we don't talk like somebody's bankable. Like they can go get money to do whatever they need to do. And, it also traditionally, I think business valuations are a big eye opener to business owners.
Right.
Everybody usually thinks their business is worth way more than it is.
Exactly.
And so this gives them kind of a reality check. In some cases, they don't think it's, they think it's worth not much and it's worth a lot. But most of the time they think, it's worth way more. So we're kind of bringing in some reality. But also it's really just a strategic planning type of thing, I think, that people can use it. Because if you don't know, with your bank account, you can look in your bank account and be like, I need to work more. It's going down, or I can slough off. But with a business, you're just like, I can't really figure out what it's worth, what it's changed, and things like that. So I think that's helpful. But we are definitely going to give your information to everybody who's listening. It will be posted, and they can certainly reach out to you via email or even phone if they have questions. Because I think they will, people do have questions about this concept.
Right.
But also your book about 30 questions. I like that.
Oh, you did? Thank you.
I do. We need to do another podcast about the 30 questions. Come on. That'd be great.
Absolutely. Absolutely. In time, we do that. Absolutely.
There you go. Well, Achille, it's always a pleasure. I appreciate you and your knowledge in this space. And hopefully we will see you again soon.
Right. So I just want to add that I'm also an NACVA board member.
Yes.
And I serve on the Valuation Credentialing Board of NACVA.
Yes.
Thank you.
Very important. Thank you, sir. Talk to you soon.
Thank you.